Hi everyone, this is Professor Gallagher, and in this video we are going to talk about adjustments for adjusted gross income. So as you'll remember from our previous chapters, adjusted gross income is defined as gross income minus a list of permitted deductions. So in this video we're going to be discussing that list of permitted deductions that is allowed before we get to our AGI. Many of our deductions and credits are going to be based on AGI, and certain tax benefits are reduced or eliminated when AGI gets to certain levels. So AGI is an important number on our tax returns. So some of the deductions for AGI that we're going to talk about in this chapter are the educator expenses deduction, the deduction for certain business expenses, and this is only for reservists, performing artists, and fee-based government officials. 1/2 of the self-employment tax, the self-employed health insurance deduction, self-employed SEP, simple and qualified plans. We'll talk about that more in our retirement chapter. Alimony that's paid, certain payments to IRA and health savings accounts, and unreimbursed moving expenses for members of the armed forces. There is a change to this law for 2018. And interest on student loans and our penalty on early withdrawals of savings. We're going to start first with the student loan interest deduction. Only interest that on a qualified student loan is potentially deductible. A qualified education loan is one that's incurred solely to pay for qualified educational expenses incurred on behalf of the taxpayer, taxpayer's spouse, or any dependent of the taxpayer at the time that loan was incurred. So what this means is that the student loan interest can only be deducted on loans that were used to pay for qualifying educational expenses. If you used a student loan to buy a car, then that would not be a qualified education expense. The deduction is limited to $2,500 per year. So qualified educational expenses are the cost of attendance at an eligible educational institution, and those costs would include tuition, fees, books, supplies, equipment, room, board, transportation, and other necessary expenses of attendance. The qualified educational expenses must be paid or incurred within a reasonable period before the loan date. The expenses must occur during the period that the recipient was carrying at least half the normal full-time workload for the intended course of study. So if 4 courses is considered full-time and you're taking at least 2, then your student loans would still qualify for this deduction. The course of study can either be at the undergraduate or graduate level, so both levels would count towards the student loan interest deduction. The deduction for student loan interest expense can be limited based on the modified adjusted gross income of the taxpayer. So the modified AGI is equal to the AGI for the taxpayer's tax return, plus any deductions for student loan interest, plus any foreign U.S. possession or Puerto Rican income that was excluded from taxable income, plus any deduction that was taken for tuition and fees, and plus any deduction that was taken in regard to domestic activities production. The deductible amount of student loan interest is going to be reduced when modified AGI reaches either $135,000 on a joint return or $65,000 for a single return, and will be totally eliminated when modified adjusted gross income reaches $165,000 or $80,000 for single returns. So you can see the phase out range for a joint return is $30,000, and for a single return, it's $15,000. So the formula for calculating the disallowed interest due to a high modified adjusted gross income is going to be the preliminary deduction, so whatever you would be allowed, times the fraction below will equal the disallowed amount of interest. So for married taxpayers that are filing jointly, the fraction will be the taxpayer's modified AGI minus 135,000, which is where the phase out starts, divided by 30,000, which is the phase out range of income. For single taxpayers, it'll be the taxpayers modified AGI minus 65,000, which is where the phase out begins, divided by 15,000, which is the phase out range, since the student loan interest is not deductible after $80,000 for single taxpayers. So this is the worksheet that will be prepared when you're filing your taxes. You can use this worksheet to calculate what your student loan interest deduction would be. This isn't something that is filed with your tax return. You do keep this for your records, but you would transfer your ending total here on line 33 of your 1040. So let's take a look at an example of our student loan interest deduction. The Greens borrowed $40,000 on a qualified educational loan to pay for qualified higher education expenses for 3 children. During 2018, they paid $2,500 in interest on this loan. The Greens modified AGI on their joint return was $145,000. They are entitled to deduct $1,667.67 as followed. So they paid $2,500 in interest, which is the amount that they can deduct, the max amount. So we're going to multiply that times their modified AGI minus the beginning phase out period for student loans, which is $135,000, and we're going to divide that by 30,000. And so $833.33 would be disallowed, meaning their permitted deduction would be the total amount paid minus the disallowed amount to total $1,667.67. So next we're going to talk about HSA accounts. A health savings account is a tax-exempt savings account that is used for qualified medical expenses. This can be used for the expenses of the account holder, spouse, and their dependents. In general, qualified taxpayers can take a 4 AGI deduction for contributions to the HSA. To be eligible for the HSA, the taxpayer must be self-employed or an employee or spouse of an employer with a high deductible health plan, or an employee of a company that has no health coverage and has purchased a high deductible policy on his or her own. In addition, the individual must have no other health insurance coverage except for certain specified coverages in the tax code. And the taxpayer cannot have other health insurance except for coverage for accidents, disability, dental care, vision, long-term care, or workers' compensation. The high deductible plan is a plan with specified minimum deductible amounts and maximum annual deductible and out-of-pocket expense limitations. For 2018, the amounts are as follows. For individual coverage, the minimum deductible is $1,350, and the max deductible and out-of-pocket is $6,650. For family coverage, the minimum is $2,700 and the max is $13,300. So taxpayers that contribute or withdraw from the HSA during the tax year must file the Form 8889 and attach their Form 1040. Contributions that are made by a qualified individual are a 4 AGI deduction, assuming that those limitations are met on that having the high deductible plan. Distributions from the HSA are tax-free as long as they're used to pay for qualified medical expenses. So next we're going to talk about military moving expenses. This is a new tax law change beginning in 2018. The moving expense deduction and the exclusion from income provision is allowed only to the members of the U.S. Armed Forces or their spouses or dependents on active duty. So the law prior to 2018 applied to anyone, and if an employer paid for your moving expenses, the amount that the employer covered was excluded from income. So now, starting in 2018, if a member of the U.S. Armed Forces is on active duty and moves because of a permanent change in station, they can deduct their unreimbursed moving expenses. A permanent change in station is going to include a move from their home to their first post of active duty, a move from one permanent post of duty to another, and a move from their last post of duty to their home or to a nearer point in the United States. The move must occur within 1 year of ending their active duty or within the period allowed under the joint travel regulations. A service member would not include in their income the value of moving and storage services that are provided by the government because of a permanent change in a station, and they would not include in their income any amounts that are received as dislocation allowances, temporary lodging expenses, and temporary lodging allowances or move-in housing allowances. Generally, if the total reimbursement or allowances that the service member receives from the government because of the move are more than their actual moving expenses, the excess would be included in their wages on their Form W-2. However, if the reimbursements or allowances exceed the cost of the moving expenses, the excess is not included in their wages on Form W-2. The excess would still be included in gross income on Form 1040. Additional moving expenses are going to include storage of household goods within a consecutive 30-day period after the items are removed from the former home, actual expenses or mileage at the rate of 18 cents per mile for driving a personal automobile when they're relocating, the moving expenses of persons other than the military service member as long as they're members of that service member's household. The service member can deduct the expenses of traveling, including lodging but not meals, from their old home to their new home, including car expenses and airfare. They can deduct the car expenses as either their total out-of-pocket expenses or at a mileage rate of 18 cents per mile. They can add parking fees and tolls to the amount that are claimed under either method. However, meals are not deductible, and they cannot deduct the cost of any unnecessary side trips or expensive lodging. A foreign move is a move from the United States or its possessions to a foreign country, or from one foreign country to another foreign country. It is not a move from a foreign country to the U.S. or its possessions. For a foreign move, the deductible moving expenses are expanded to cover the reasonable expenses of moving the service member's household goods and personal effects to and from storage, and storing those items for part or all of the time the new job location remains their main duty station. The new duty location must be located outside the United States. So let's take a look at an example of this, of how we would apply this tax law. In 2018, Rena, a naval officer, was assigned to a new permanent duty station and moved from Seattle to Pittsburgh to begin work. She incurred unreimbursed moving expenses for her household goods and furniture of $3,500. Prior to moving, Rena flew from Pittsburgh to look for a new residence. The transportation and lodging for this trip to Pittsburgh was $900 and her meals were $250. The unreimbursed cost of her travel during the actual move to Pittsburgh was $500, which included $75 for meals. So we need to calculate the amount of Rena's military personal moving expense deduction for 2018. So her moving expenses for her household goods and furniture of $3,500 would be deductible. Her trip prior to moving to look for a new residence would not be deductible. The unreimbursed cost of her travel, which was $500, however, that included $75 for meals. So since meals are not deductible, we would need to subtract the $75 from the $50 to give us her total moving expenses for her actual move to Pittsburgh is $425 plus the moving cost of her household goods and furniture to give us a total deduction of $3,925.